Well, hi there, everybody. Good evening. Welcome to, I'm going to call this my first webinar I've done since I was out of the country, which I was over the last, 2 weeks almost.
Yeah.
Uh, Thank you all for your comments that you sent to me. Those of you that have been hanging out with me throughout the year, you knew I was going to New Zealand eventually and going to drop down to the other side of the world, and I did. And I'm going to show you pictures. Um, Joan, I got to tell you, I passed by your family's winery more than once. I tell you, it was like speed dating down there. That's how busy I was. I'll show you guys a couple pictures as well. But also, I want to do a market outlook, and I want to talk about system mastery, and how to take a simple technical indicator and turn it into a live working trading system. So I've got that. That's tonight. Tomorrow night, we're going to talk about cryptocurrencies. And I'm going to show you, for those of you that have never traded cryptos before, how to get a double-digit return with just a few simple mouse clicks when you start your cryptocurrency account. All right, instant double-digit return, and all of you will be able to actually do that. You'll be able to do that tomorrow night. So I'm going to show you that tomorrow night. All you got to do is just be a rules-based trader and just follow a couple of rules that I'm going to give you. Okay. So, welcome everybody. I want to welcome all of our partners. You know, part of what we're doing over the next 2 days is we're going to talk about my upcoming System Mastery series, which is a once a year program I do. I decided to step it up a little bit this year. I typically do it toward the back half of the year, but I'm adding cryptocurrencies to it, and I want to get people have been just banging on the door. Tom, teach us this stuff as soon as possible. So that's why I've slid everybody else back, and I'm going to be doing that starting next week. I'll talk a little bit about that as well as we get to the end of tonight's program as well as tomorrow's. So before we begin, you got the disclaimer in front of you. A couple quick notes, guys. We got a nice, well-packed room tonight, and again, just a few things here real quick. Couple housekeeping notes. Obviously, number one, if you got questions to ask, you can ask them right now in the Q&A box. I'm going to tell you right now, we're not going to get to all of them. There's just no way with the amount of people that are on that I can get to all those. So I will get to as many as I possibly can. All right. Number two, this session's being recorded. I'm going to get it to you as soon as possible, probably within a couple of hours after the live broadcast is done. Number three, disclaimer on the screen. You can read this word by word. I'm going to give you the recording. All you got to do is pause the recording. You can read the whole thing. A couple of pieces I want to point out before we get going. Stock and options trading has large potential rewards, but also large potential risk. I kind of make that sound like this. Trading is easy, but making money is not, okay? I believe that in my opinion, you have to be a rules-based trader. You have to have some methodology that's going to get you through the good times and bad, all right? So that's something I want to talk about. The second thing is that myself, Optionetics, and Tom's Trading Room, all right? This is the educational group that we're doing here. We are here as your educators, okay? We're not investment advisors. I do not give personalized, specific trading advice. Right, you need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight is in U.S. dollars unless noted otherwise. Okay, so real quick, a couple things I want to share with you. So Jay, good evening. It's been a good couple weeks since I've
Good
talked to you.
evening. Good to hear your voice, man.
Yeah, I'm glad to be back. You know, I've had like zero sleep in the last several days. We were out. I took the first real vacation in about 2 years that I've taken, and it was tough because that time change going out. It was a 10-day trip going out and coming back, and you know I got back a couple days ago, and I'm still kind of screwed up with the time change. Just real quick, show you a quick little pic. So this is me and part of the family standing on our piece of property out there in New Zealand. It's a beautiful piece of property, overlooks the Tasman Bay. And Joan, I got to tell you, so we're going up from, you'll know this, and any of you that are Kiwis will know this too. Well, most of you probably do, maybe not all of you, but you know, we're on the South Island, so we're leaving the city of Nelson. We go through Richmond, and all of a sudden, then we have to take that right-hand turn, which goes up all the wineries as you're heading toward Mapua. and I saw the Seafried Winery, like I said, more times than I can count. And I just did. I wanted to go. We really did. In fact, I was actually telling the family, those people watch me and listen to me on Tom's Trading Room. I got partners that are the Seafrieds, and so it was really cool. I wish I could have went, but I promise you I will be going next time. Now let me tell you something else. I'll tell you how small a world this is. I know where Howard lives. Okay, Joan, you know this. Nobody else in here does. I know exactly where Howard lives because one of my closest friends lives right next to him in Kaiteri, which is where I was. And so that's what made this so cool. And I wanted to tell you, I didn't even tell Jay this. He's just now finding out. But the owner of Seafried Winery lives. I'm not even going to say the name of the street because I don't want to give it away, but I know exactly where he lives. And it was really cool to find that out when I was telling my buddy as we were actually at his house on that private beach in Kaiteri. And Joan, you probably know exactly what I'm talking about. Anyway, really, really cool. A couple other quick things I want to mention. So we're building a house, and this is the kind of the schematics that we're putting together. And, this is pretty widespread out. And so it's got little different wings on it. It's got little pieces to get to your bedroom and such, and then the big piece in the middle. This actually overlooks the ocean there. I'm saying this because, and then of course, here's where we are right now. So I had the drone fly over and take a quick shot of where we are, and we're in the framing stages right now. And so it's coming together pretty cool. The thing I want to mention is this: I've already given away a couple of, once this thing gets done, a couple of weeks to one of our students, and I'm giving away one to charity, and I've actually got two of them going to our students, one to charity. I'm not finished yet because some of you that are our Optionetics / Tom's Trading Room group, all right, will be getting a chance to come to the private residence and spend a week there. And I'll give you more details as this thing starts to come to fruition. But we think it's going to be done. The custom jobs aren't done easily over there. There's a lot of stuff we have to import in, but we've got a projection of having this done by the end of the year. And so I'm very excited about that, and I want to share, as many weeks as I can going forward with you. All right, so that you can get the opportunity to go down it, because it's absolutely amazing. We actually had a helicopter take us around and fly us right on right on the grass out there behind the place. So we're actually going to be able to airlift back and forth to airports, back and forth to national parks, or anywhere that you want to go. So we're just real excited about this. So let's go ahead and get into something else I'm excited about. And I want to do a quick market outlook with you because I haven't been back. And like I said, I landed, I think Monday. It was Monday afternoon when I finally landed back in Florida, and I got stuck in San Francisco for a day, which isn't the worst thing in the world, but it is when you haven't gotten any sleep and you don't plan on getting any sleep. And we were stuck there for, I think it was a 12-hour layover. So we headed out and went to the city, went to the Golden Gate Bridge, and kind of messed around and killed some time before we then made our way to Chicago and then finally to Florida. I haven't done a quick market outlook. I typically do this on Mondays to our professional traders. So I want to take a look at it. I want to show you guys that are part of our group where you can find that. So if you're a member of Tom's Tools, then simply log in. And if you're one of our contrarian or complete trader, right in this area where it says newsletter, okay, so we have the option trader, the contrarian trader, the complete trader, and then I've got something over here I'm going to talk about later tonight, which is Partners and Masters. Just click on the newsletter. We upload this up. This goes up every Wednesday night. All right, so this is fresh off the press here, and you can see that we talked a little bit about the Fed raising rates, and we talked about how that's going to affect banks. Then we get into the four corners of the market. We're talking about right now the S&P, which has been testing that 100-day moving average, and it needs to bounce from here. And I believe that is indeed going to happen. Now that this is out of the way, and I think the Fed chair did a great thing because we knew that with basically what's going on over here in the markets, the economy is so hot that they needed to bump the interest rate up a little bit. And I think it was just right to keep this Goldilocks phenomenon in check. What I'd love to see is us get above the 280 mark on the S&P. I don't think it could be that long before that actually happens. All right. But I got to tell you, I am disappointed how the month of March has been treating us. January did exactly the opposite of what I expected it to, right? But so did February. February was scheduled to be mid-February, really more of an up month, and it wasn't. And March is supposed to be an up month too, and it's been bouncing around, and we're kind of like where we started at the beginning of the month. And so I've been disappointed about that. But I also know that long term is what I'm shooting for, not what would happen in a couple of days or weeks, and even maybe even a couple of months. I find it about 2 months a year that my patterns, especially calendar patterns, can be off, and so that's it's something that I build in. Now that being said, mid-February, the last time that we all spoke as a big group, we were discussing the energy markets. And the energy markets have actually been moving in our favor. And so those trades, for those of you that were with me last month, we were talking about the energy markets. We were talking about energy opportunities. Those trades we discussed in XLE, guess what? They're profitable. They're moving up. They're doing exactly what we expected them to do. And I believe that you're going to see oil and the energy markets continue. All right, we'll get to that in just a moment. But that's the S&P. So we also look at TLT, the bond market. And as you can see here, we had some buying opportunities in bonds. We got a sell signal the other day in bonds. And that doesn't mean bonds are going down, but what it means is that the market may have run out of steam to the upside. Now, I'm going to be real curious to see what happens to bonds now that the Fed only raised 1/4 of a point, whether or not that's going to bump us up again. I do believe we may get up to around 120 one more time before pulling back, all right? But I do see that 120 area as a potential resistance area for bonds, all right? FXE, now this is the one that is really the hardest to track and follow. And what we're seeing now is a triangle pattern that's occurring. We've gone from a box pattern, which began all the way out at the beginning of the year, and we've been trading in this range between 117 and about 120.5. And now we're getting into an area right here where it's like a coiled spring. This thing is going to break one way or another, and now it's either going to break to the upside, which is where it is right now on resistance, all right, on this declining resistance, or we could come down and take out yesterday's low. I don't think that's as big a deal as getting down here and taking out the 117 area. All right, I do believe that Europe should move higher. That's also good for the stock market. So if the bond market moves lower and foreign currencies move higher, that really artificially makes stocks become more and more expensive. And then finally, you've got the oil market. This is USO. Now, USO is coming back up to the top of its flag pennant. And if you take, for instance, if you're a technician, which some of you in here are, and you take this 13.25, which is basically where we are right now, and you come down here and you take this low, which was around 11.75, all right, that's about $1.50 right there. And if you add $1.50 to 13.25, you're sitting up around 14.75, which is another huge move. It's above where the chart is right here. That would make our energy trades, our energy opportunity trades, really bolster into profitability. All right, got a lot of other information on here. I'm not going to get into observations, some ideas of what we have going on in the marketplace and such. You can just go ahead and just click into the newsletter. You can get all that information right there on our option tools. All right, so let's move on. And I want to talk about tonight. I really want to cover in next 45 minutes or so. I want to talk about rules-based trading applied to technical indicators. We're going to take one of my mentors and my partner, God rest his soul, George Fontenilles. We're going to discuss the 1030 crossover, and we're going to take it from being something you see on a chart as an indicator to actually a system. And then I'm going to show you how we've created something off of that called Triple Threat, which is brand new actually for 2018, as we're now using something that I like to call dynamic optimization. And we'll talk about what that is as well. And of course, I'm going to cover for, about 5 minutes or so at the end of the program, my once a year 2018 mastery program, something that I do personally once a year. It's an 8-week program that we do. And this year I've put together more information and more of this particular program than I ever have. So if you've waited until now to think about joining us in our system mastery program, this might be the year to do it. And there, this might actually even be my last year I'm doing it. I'm not for sure, but I never claimed I was going to keep doing this for the rest of my life. This premium service that I do, because it takes so much time to do. But I'm going to show you that. This is actually going to start next week. So let's start with trader types. So trader types, and this is where I believe this is something all of us here do. All right, all of us, as we start out as traders, begin at the discretionary level. Most of us do not get past the technical trader piece. But I want to encourage all of you in the room to try to take a step farther than discretionary, farther than fundamental trading, farther than technical trading. And let me just talk about these three types. Now, I was a discretionary trader when I first started. And discretionary trading is basically someone who uses intuition for their trading decisions. That's someone who says, I think Facebook is going to go up, all right? Or I think Tesla is going to go up. And they use the fact that they think about it. Now, what makes you think about anything? Typically, garbage in, garbage out. So if something plants a seed in your brain that is based on intuition, wow, I think Facebook is going up, then you hear that enough times and you might start thinking it's going to go up too. But what did you do to come to that conclusion? More like thinking, which becomes hoping after you get into a trade. All right. Most discretionary traders, they have no idea as when they're going to take a profit, and they definitely don't have an idea as when they're going to take a loss. All right. Most discretionary traders don't even use discretionary trading does not even include options trading, because at least options trading, you have some sort of a built-in stop loss. Okay. Now, if you get past being a discretionary trader, you might become what we call a fundamental trader. Well, fundamental trading is really not trading in a sense, because fundamental data on a general comes out once every 3 months, and that's in the form of earnings. And so, fundamental trading, you get a piece of data every 3 months on that company. And now you might get news on that company, but it may not be fundamental news. It might be breaking news. But every 3 months you get information. Now, let me tell you this. I use fundamental information in some of my analysis. I can't just use what comes out every 3 months. I need at least a year of fundamental data to help me become a trader. Most people that use fundamental data are not traders. They are investors. They're in it for more than a year. Now, we can use fundamental data in our trading, but you got to know how to use it, okay? Technical trading, that's where a lot of folks migrate to once they realize that hoping and thinking doesn't work. Then they start to become more of a chartist. And I would say 99.9% of traders that use charts don't go any farther than a chart and maybe a couple of indicators to help them predict the future. But they don't backtest the methods. They don't actually create real rules for when to get into a trade and when to get out of a trade. Or maybe they say, oh, when we bounce off the 200-day moving average, I'm going to buy the stock. Now, that's an idea of taking a technical chart and trading off of it. But did you backtest it in the past to see how it worked before putting money into a future move? All right? Most people do not. I encourage you to consider trader type number 4, which is what I call a rules-based trader. A rules-based trader does 3 things really well. They research a pattern, regardless of whether that pattern is fundamental, technical, seasonal, whatever it may be, and then creates a set of rules, a set of objective trading rules for entry and exit of the markets. Maybe your pattern is, I'm going to buy the S&P on Monday and I'm going to sell it on Friday. That might be the dumbest idea of a rule that's out there, but you know what? It's a rule, because everybody in this room can say, buy it on Monday, sell it on Friday. You understand that you can go back and back test, how did it do between Mondays and Fridays, right? Maybe you bought on Friday and sold on Monday and you stayed out of the market the rest of the week. Wherever that is, that can actually be back tested. That can be forward tested. You can find out things like how well it did and how bad it did over a series of several different moves back in time to see if it's something you want to consider trading. And then after you've researched that pattern, you've back tested the rules, you then will trade those rules when you're confident in your backwards and forward testing. That's what a rules-based trader does. Now, before I move forward, I only mention Monday through Friday because all of us could quickly understand that is a rules-based system. I'm not implying that it actually works. All right. So there's my man. There's George. This was long ago, George and I on the stage of one of our Oasis seminars that was held in California. This was amazing. We had thousands of people in the audience when we talked about things, and George always used to discuss this one market indicator that I want to share with you. And a lot of people used it. They really liked it. I thought that we could go a little bit further, and I want to show you what I've done with this indicator over the years and what I've done to make it even better. And so here we go. So his favorite indicator was a moving average crossover. Now, a moving average crossover is something when two moving averages of different lengths are on the same chart. Right, the short-term moving average and the long-term moving average. Now, the shorter-term moving average is going to be more reactive because it uses less data to determine what that moving average changes to day by day. And the long-term moving average will be longer to react to the market. Now, as the markets go up and down, these two averages, these two lines, will cross at certain times. And you can use those crosses to actually create a bullish and bearish trading strategy. So, here's an example looking at Tesla Motors. And you can see this was last year, and this is when Tesla was trading in the twos. It was actually trading above 250. But look at this. This was a 50-day and a 200-day moving average. Now, these are pretty far long-term moving averages. But you can see the 50 crossed above the 200 right here when Tesla was trading just above 250. Tesla got up to almost 290. Then it pulled back to about 240, hung out here for a little bit, and then started its lengthy move all the way up into the high threes, right? Watching that moving average, and as long as that purple stayed above the gold, that was a bullish indicator using a long-term moving average. But is the long-term moving average, does that make the most sense to use? Because maybe as an investor it does, but as a trader, it may not. A trader may want something that's a little more reactive, something that includes shorter term moving averages. George's 1030 crossover involved the 10-day moving average and the 30-day moving average. And he used what was called a simple moving average because it was very simple to understand. And so what happened was when the 10-day simple moving average crossed above the 30-day simple moving average, that was a buy signal. And when the 10-day moving average crossed below the 30-day, that was a sell signal. And so we can look at these. By the way, you can find, I'm not going to, sugarcoat this. You could put moving average crossovers on anything. Listen, if you're using a software program and you can't put a moving average crossover system on it, whatever that program is, get rid of it. Because every software program in the world has moving average crossovers. All right. We have moving average crossovers in Tom's Tools, and that's what I want to show you. Now, this is an example looking back on Sears Holdings. You can see Sears Holdings. Remember that one? We had a sell signal. All right. There's your sell signal. Here was a buy signal. This is the 10 and the 30. So now the 10 is the purple line and the 30 is the gold line. Buy signal, sell signal. Then it came on down. So this was an example of this particular crossover pattern giving you times to buy and times to sell on SHLD. Works in both bull and bear markets. Here's Lululemon. Lululemon had a little sell, then a buy, and then it ran all the way up to right up before earnings. And then it had the sell, and it came down. Okay. Can also work across anything you can chart. This is the iShares Mexico Investable ETF. And it shows you a sell here back, in May of last year, and then the buy that came in July, and then the sell that came again in near September. Right, so this can work across anything you chart. You could use it on cryptocurrencies, which I'm going to be talking about tomorrow. Right, here's some best practices with 1030s, because if you apply this to every stock, some it's going to work on and some it's not. So how do you pick the ones that it works on and stay away from the ones it doesn't? Well, here's a couple of things you can do. All right. So like I say, stocks will come and go with the system. They calm down. They don't work as well. So it's best to find stocks that move about 2 times the market. That means you're looking for a beta of 2. All right. Those are more likely to swing. And this is it is a trend trading system, but you need big moves in the market to catch both sides. Now, can we scan these on Tom's Tools? Absolutely. Now, this is something that, again, I'm going to say it one more time. There are some less there's less software programs that can do the scan than others. All right, if you have a program that can do the scan, you can do this just as quickly as I can. But we can scan these on Tom's Tools. Now, this is an example, and the way I got to this particular scan here is I'm going to show you right now. So in Tom's Tools, right, we have a couple of different ways you can scan these. One way is, let's just go to Tom's Tools when you log in and you see those option trader, contrarian trader, complete trader, and partners and masters. Over here where it says crossover, right, you can click on crossover. And if you click on crossover, that's going to bring you to the part where you just click on the search button. When you click on the search button, it already has 30 and 10 in here. Long days 30, short days 10, and I have it running on the S&P 500. And you can see here, there's a scan that I'm just about to show you. I'm pumping it up here so you can see it better. But you can see Con Edison is on this list, McDonald's, Black & Decker, ConocoPhillips, Southern Company, Anadarko, Ameriprise, C.H. Robinson, O'Reilly Automotive. Couple things I'm going to point out to you. Con Ed, Conoco, Southern, Anadarko, C.H. Robinson, and O'Reilly are energy and transportation stocks, and they're all getting bullish signals today. All right, that's something to look at. Another one that's on here is McDonald's, a stock I'm currently bullish on. All right, a stock I've got an option trade on right now. And it took a bullish swing today at 159. Now, I think I'm in this one a little bit higher, but I like this because now McDonald's has kind of come down, and is it possibly now in an area where it's now become cheap to investors? A lot of people believe so after today. I like that. I'm only looking for 165 on this one. I'm not looking for, back to 180, which is where it was. It's down over 10% from the highs that occurred in January. But I would be happy with 165, which is only 6 points away. That's all I'm looking for. So keep that in mind. We're going to look at McDonald's. I'm actually going to pinpoint that one. There's a reason why I want to look at this one a little closely. One has to do with the slippage. All right, I like these low slippage numbers. This means I can get into trades and get it out of them very efficiently. The other reason I like it is because of the ones that are on here, it's the one at the top that needs the least amount of movement in order to double in value. Okay, so this is something that's very interesting to me as well. Okay, so what I did here was I simply went in and I ran a scan using our crossover search. And you can change the numbers to whatever you want up here, and you can change the list. You can make your own list, right? And then from there, you can run your crossover scan, and then from that point, you can go in and you can find out more vital information on the stocks you're interested in. Now, I'm going to move a little bit farther in with McDonald's, and then I'm going to look on the Q&A board. So Jay, why don't you pick out the most popular questions right now to date based on what we've done so far, and get ready, because I will give you the queue if there are any available. If you have questions on this moving average piece at this time, start plugging them in now. All right, I got a couple more slides, and then I'm going to go for a quick Q&A. So how effective is the 1030? And Jay, I might be answering questions that are coming up right now. So one thing that we know is that it works better on more volatile stocks. It works better on higher dollar stocks. It works better on these because they tend to have that 2 times the beta move. Now, is there a way of finding out which stocks this works best on inside of looking at the S&P 500, for instance? And the answer is yes, there is. Okay, because I can go in and I can back test these. So do you see what I'm doing? I'm actually taking this strategy and I'm going in now and I'm going past just looking at a chart. All right, we can look at a chart. Let's take a look at a chart of McDonald's right now. I think I have it up here. Here's a chart of McDonald's. You see what's going on here? So I've got McDonald's on here and I've got a couple of the peaks, what we call chart peaks. This is something that's proprietary to Tom's Option Tools, which is really cool. But notice what happened. Look what happened here. We got the buy signal on McDonald's right there today. That's based on the fact that the 10 period is crossed above the 30 period right now, right? And so based on that little piece of information there, this is looking like around a 30 to 60 day window of opportunity to potentially move higher. All right, so that's our chart. But if all you do is just look for these and look at charts, you're not doing this service. You're not being a rules-based trader. You're in the technical realm right now. To get to the rules-based realm, you want to go back and see, well, how well did McDonald's do? You know, what were our best performers? So what I did was I took all the stocks in the S&P 500 and I back tested them over the last couple of years. And what I found is this: McDonald's, the Dow Jones Industrial Average, AbbVie, and the Dow Jones Industrial Average again were the top 4 stocks that had percentage winners over the last, I think it was last 1,000 trading days. And so you take a look here and you can see, now this system does not give you, this trading strategy does not give you buy signals every day, because part of the methodology involves a 30-day moving average, right? You might get 1 or 2 signals a year. And as the event you can see here, this was, you got 3 signals in McDonald's, 4 in the Dow, and by the way, 2 of those were bearish, I want to mention. 2 in AbbVie and 4 in the Dow Jones, and another version of Dow. So you got Spider Dow, and you got DJX. And so these were 4 of them that we could, that you could go back in and you could actually look at serious back tests on these. And so that's what we ended up doing. So taking ourselves from indicators to systems. In order for your indicator, right, that's this. In order for this to be a system, you have to be, number one, it's got to be 100% mechanical. That means you should be able to look at it and know without a doubt that it's giving you a signal or not giving you one. It also has to be repeatable. It also has to be able to back test the rules for getting in, the rules for getting out. And you need to be able to scan it for efficiency across all markets for future opportunities, which is what this is, all right? The ability to go in there and, like I showed you, bring up this information very, very quickly. So here's McDonald's, and this is the back test on McDonald's. So I ran the back test on McDonald's, and it gave me those buy and sell opportunities. And it shows me right there, based on me just clicking on the pick for McDonald's, because I ran the back test, and from here it showed me a channel, but it also showed me the last buy, the last sell. Here's the buy signal for today, and potentially moving higher. Also shows me where the trade leg is if you're buying the stock. Now, how many software programs could do that? There are a few that I can count in my head if you have the programming knowledge to be able to program this in. You don't need programming knowledge with us. We have all this stuff kind of set up. All you need is to put the information in, how many days you're looking for the short term, the long term, and then bang, it does all the work for you, right? But I want to show you one more thing. Now, the way I found this was I went into something we call moving average stocks. And there's my McDonald's trade, and I'm going to click on the pick. So I want to show you that this actually was real, and it wasn't something that I painted green to make it look good, right? There's your chart. There's the buy and sell like I showed you on the presentation, right? But I want to show you one more thing. We can go in, and I can go back. So if you go to searchers, and you go to moving averages, and you go to stocks, this is where I started this whole thing, all right? Check this out, though. I can do searchers on calls and puts. I can say, well, let's take a look at McDonald's, all right? Let's back test this thing again. I'm going to put 500. I got 1,000 and 500 in here. And I'm going to run the search one more time. But this time what I'm going to do is I'm running it on the options. Now, look, I still got 100% winners on the options. But what it does is it goes out there and it shows you what option trades made the most sense. And in this case, it was in the money calls, all right? One strike in the money calls, because I can tell the stock's trading at 159 and this thing's at 157.5 for its next trade. And so we can see there, that by looking at this, and it's showing you where to buy, where to sell, but then what it's doing on the back test is actually looking at an option to trade at that time. Now, let me ask you this. How many pieces of software do you know can do that? I only know of one, and you're looking at it, all right? Every piece of software can do a moving average, crossover. And a lot of them can go in there and you can create with, not a lot of them, a few of them you can go in there, you can create buys and sells on the actual stocks. But we're the only ones that I know of that go back and actually can back test the option strategies for you as well. And I think that's pretty incredible. And so I bring that up because I want to show you a couple of examples of, some things to look at. And so with McDonald's, as we move over into a trade, and then I'm going to take some questions. Jay, do you have any questions?
I have a couple.
Perfect. Hang out there for just one more minute. So I'm looking at McDonald's right now, and the stock's trading at 158.66. Now we could go in there, we could buy that 157 call. But something that's gone up with McDonald's, and it's gone up with the entire market, has been implied volatility. We've seen a bump of practically double on McDonald's. So where we are in the 10 to 12 range on IV, all right, look here now, IV's kind of around close to 20. So now that means that this $4.08 option about 2 months ago was only $2.08. So we've seen the time value double in value, all right? So now instead of going in and simply buying calls, we might see McDonald's go up to that 165 area, but you might not get the kind of return that you would if you went in and possibly spread the option. So I'm looking at potentially a 160, 165 call spread, all right? So what's that going to look like? Well, let's pop the risk graph up and take a quick look at it. And we can see here that for $166, now I'm not paying $4. I'm paying less than half. And I still got a trade that has the potential of yielding 200% return on the cost. All right, so 166 that could make a 334% maximum reward or 201% return on cost. All right, so to summarize where we are so far, we've gone from an idea, all right, which is a repeatable pattern. And now we've gone back and we've been able to scan that pattern on stocks. We've been able to break a group of stocks down to the ones that are performing the best. And then we look at each of those to see how they performed trade by trade by trade. That's called back testing, right? It helps me weed out some of the stocks that I don't want to trade this particular strategy on. So Jay, hit me with some questions.
Just a couple here. For the most part, it's about timing. How far out do you place your options expiration for the 1030? And then
that's a great answer, and it's going to be different. I'll tell you that answer right now. So what I see in terms of bullish strategies, that 60-day option makes good sense. If it's bearish, if you get the 10 crossing below the 30, you can go with a 30-day option because, as we all know in here, the bull takes the stairs and the bear takes the elevator. And that's what I mean by that is that bullish moves take usually 2 to 3 times as long to make as bearish moves. So you can use a shorter term option when you find stuff to the downside. Now I remember we did this last year and we had Tesla as a bull and we had Costco was a bear. And both of those turned out to be really nice. And Tesla made the move to the upside, and it did it slowly. And Costco made that move like within a week or two. We came back and noticed that Costco had slammed down really hard. And I did it on the big screen. In fact, I was going to be on the big screen tonight, but all my lighting is all screwed up. I'm going to try to have that all fixed tomorrow, and maybe I'll be on the big screen tomorrow night when we do cryptocurrencies. So what's your next question, Jay?
Rules of exit.
Rules of exit, like anything that I like to do, get out of half of your trade if it doubles in value. That means whatever you put the trade on, whether it's a call, a spread, a put, or a put spread, look to try to get out of half of it when it doubles in value. And then what you can do is you can hold the remainder until the strategy tells you to change. So if you get a crossover to the upside, let's back up a bit here. So see this McDonald's trade where, let's look at the bearish side. So it crossed down. And you're really seeing about 6 weeks there, 4 weeks, and about a month, and then you got the buy signal. So you could have maybe gotten out of half of it when it doubled in value, somewhere maybe around here or maybe on that spike down. And then the rest of it you get out of if the signal turns bullish or if you're running out of time. That's the other thing too. If you're starting to get closer and closer to expiration, And that might want to tell you to get out of that too. So, are we ready to move on?
Yeah, I mean, somebody asked if you had some Fibonacci views on McDonald's. I don't know if you wanted to bring that up with the moving average stuff that you got going.
Well, part of what we do with peak peak resistance, or the chart peaks. I'll throw the chart peaks up here real quick. Is chart peaks are a bit of that, this Fibonacci resistance and support. And as you can see here, we've got kind of a couple of black lines, and then we got a couple of blue lines, black and blue. All right, that's the way this market's been treating us in some cases the last couple of weeks. But you know what? You're in there for the good, you're in for the bad. But I mean, the blue are supports, and we just hit a blue line of support. And I think if we can get above this resistance area, which is 164, even if we get to 164, I'm happy, because this trade more than doubled in value if it happens in the next 30 plus days. So and then look at earnings on McDonald's. So McDonald's earnings are coming out in 40 days. I would likely want to be out of this trade before earnings, because we all know earnings is the risk in most moves that happen in the stock market. So if you have some money in your pocket on any trade as you're coming up into earnings, you want to think real hard about at least getting out of half that trade before the earnings come out. All right. So now my question is, can we improve upon this? Can we improve upon what we've done so far? And this is a 10-year back test through the stages of a system build. So I'm taking you from what I call the 1030 to what we call the triple threat trader, right? And I'm going to talk about what the triple threat trader actually is tonight, right? I've never talked about this before with our groups in the past. I've done this with our premium groups, our folks that have joined us for System Mastery. But tonight I'm actually going to share this with everybody, right? Because I think you're going to want to hear this and how to take the noise out of this particular type of trade. So from here, I want to show you Google. So we have a long-term back test on Google using the 1030. This goes back to when George was talking about it, when Google had first started trading in 2004. All right, so we're looking at these results in Google, and you can see the last 10 years, it's done really well because Google is a stock that moves. And now GOOG has now become GOOGL, depending on which one you trade, but they both correlate real well. So we have the back test where just the 1030 itself, 77 trades over 10 years. So that is what? That is, if you look at if you get 77 trades that are both bullish and bearish over a 10-year time frame, well, that's 7.7 trades a year. That's a lot of trades, right? Of that, 40 were winners, 37 were losers. So it was only a 51% return, but it made a lot more money on the gross profit than it lost. So the total profit, that total gross, which is gross profit by gross loss, it gave you your total profit. That was before commissions, all right? That's a great start, okay? But take a look at 77. Look at average trade profit too, 1584. Look at winners and losers. So the triple threat trader is something that we use, which I call it optimized dynamic moving average crossovers, all right? So I'm going to give you triple threat trader number one. Triple threat trader number one, and you know what I'm going to do? I'm actually going to kind of write this in a sense, okay? So triple threat trader one, which is what I'm about to show you all right now, uses the 10, the 30, and guess what? It uses also a 200-day moving average, okay? So triple threat 2, or TT2, that's something even more. It now uses what we call optimized dynamic moving average crossovers along with a noise filter. But what we were doing, and it works quite well, and I want to show you the back test on this, is you still use the 1030. So if you get a bullish cross, what you're going to do is you're going to look at the 200-day moving average. And you say to yourself, where's the 200-day moving average? Are we above it? If we are, that's bullish. If we're below it, scratch the trade because it's in a long-term trend down, okay? Just like the upside or the downside, let's say you're looking at bearish opportunities. So you're looking for the 10 to cross below the 30. Where do you want the 200-day moving average? You want it above the stock market because you want to be kind of jumping in that downtrend. What that does is that actually takes the chop out a little bit more. And so all of a sudden your back test, you got a lot better. And it was still 78 trades. It was still 41-37. Okay. That was where we just simply changed to some money management rules. Okay. And we added stop losses in, and that maybe did okay too. But the great thing we did was adding in some money management. So once again, going from regular to adding in only trades that use the moving average along with the 200-day moving average, looking to see where the stock was. Was it in a bullish uptrend? If it was, we'll take the 1030 buys. If it's in a bearish trend, we'll take the 1030 sells, but we won't go against them. And it did much, much better in the past. All right. We added stop losses in that way, using the stock, because this is just stock. This is not options, guys. This is just stocks. And so adding options, that brings down the cost of the trades. That brings up the reward on return on investment. And so I'm just showing you 2.0, add some stop losses in. Well, it did okay, but you know what? We stayed typically within a 10 to 15% range in terms of it going against us. And here we added money management. What money management did was as we made money, we added more money to the next trade as a percentage. We pressed some of our winnings into the next trade. Okay? And so that's what this does, is it allows you to do that. Now, dynamic optimizing, what that does is that constantly looks at the short term, the long term, and the noise filter, and gives us what we feel is the absolute best opportunities with this triple threat trader. And that's something that we're going to discuss next week when we start System Mastery. So let's look at some case studies, and let's talk about options as well. And Jay, you mentioned the question about what type of options are best to trade here. And so we're going to talk about that. Number one, you look at the target price for your stock to move to. Number two, you look at your target time. And then three, you find an option trade between today's price and where the target price and time are. And so let me put that into a little bit more specifics. So if you're looking at McDonald's, for instance, and let's look at McDonald's real quick. All right, so here's that McDonald's trade again. And this is really not the graph I want to look at. Where's the graph I want to look at? I want to look at the graph. I showed it to you guys earlier. Let's find that chart graph again. Here we go. Nope. Was this it? I went back. This is it. I went back and did a back test, and we were back testing just the McDonald's stock itself. Here we go. Look at this moving average chart again. And you can see here 160, all right, 170, 170. And this came down to about 155. All right, so we're looking right now at somewhere around perhaps a 7.5% move. Right? We could even conservatively make that a 5% move. Right? But call it 7.5. 7.5% is about 10 points, a 10-point move. So when you're looking at McDonald's stock, you see where it is today. It's trading around 158 or so. Then 168 is going to be your target. So what we've done is based on past movement, we establish our target time, price. Okay? Based on what happens over time. When you look at the back test, you'll see that this happens at around the 30 to 60 day time frame. So you want to look at 30 to 60 day options. Okay. So target price, let's call it 10 points. All right. Target time, let's call it 30 days. And finally, we're going to find an option trade between today's price and target time. And so that's what I did when I came over here, and I thought I'm going to look at some options. And I looked at some options that were 30 days out. That's the April 20th. That's the third Friday. By the way, those are the most liquid. And then I'm coming out here and saying, don't get more than 10 points above where we are now. So we're 158.66. I don't want to get above maybe that 167.5. So what I did was I looked at buying inside of where we are now and where our target's likely to go. So I'm looking at 160, 165. All right. All looks good. And I was able to do this for less than half of what buying a simple call option would cost me. So now that we've done that, we have taken care of all the rules of what we call the RBT option trader. Now, I've given you a case study already, and that was McDonald's. I want to show you a couple more that are popping up on the triple threat, and that is we look at some bulls, and you'll see the top three bulls: Valero Energy, Ralph Lauren, and Anadarko Petroleum. Right? Let's go look at these a little bit in a little bit more detail. So I've got them already lined up for me. I got my triple threat bulls here. Here's Valero. So I'm looking at Valero. I'm kind of coming across, and I see all kind of what you didn't see. All right, I'm seeing it now. So let's go ahead and take a look at it. So Valero, I've got my beta. All right, that beta is kind of it's not the best beta in the world. It's below $1. If I'm going to take any of these top three, I'm looking at Anadarko because it's got a 1.45 beta. Right. I've also got a potential 62.5 70 call spread, which I could look at here. The slippage is the lowest of the three. That's even good too. All right, I got days to expiration and days to earnings. So Anadarko's earnings are coming out in 41 days. I want to think about being out of those, but at least I got something that's expiring just past the earnings in case it moves and I want to stay in half that trade. All right, and so from there, let's just click on this. Let's take a look at it. So Anadarko looks like a potential bullish opportunity. By the way, this fits the energy opportunities that we talked about last month. All right, remember last month, Anadarko wasn't trading that much more below where it is now. I mean, it was trading, let's call it in the mid 50s, and now we're trading at well, it closed at 61.50. All right, and we could look at Anadarko, and based on the move, based on what this thing gave me, saying that we've got a potential for a pretty big move here that could get to 70. So the 62.5 70 calls for May. All right, these are out there almost 60 days to expiration. $212 debit, potential return of 538. That's a 253% return, maximum return on investment. All right, again, that's buying the May 18th 62.5 calls and selling the May 18th 70 calls. And looking at that right now, it's priced out at $212 for that option spread. Just want to show you that one. Let's take a look at a bearish opportunity. And the two bearish opportunities I have here, all right? And both of them look, a little But I mean, you got Philip Morris here and you've got AT&T. Let's just take a look at each of them. And I can see them right here. The betas are less than 1. So we're probably going to kick out both of them. So I don't want to do either one. Even though they came up, the thing is I like to see that beta greater than 1. I'd love to see it at 2 or more. But, we're talking about stocks that are lower priced. So that's going to happen sometimes. All right. So there are 2 triple threat case studies I wanted to share with you tonight. And again, the first one we were looking at was the risk graph on McDonald's. There's your McDonald's, looking at the April 20th 160, 165 call spread. Right now, that's trading at $1.66 or $166 for the spread. Okay. And then, of course, number 2 is the Anadarko APC 62.5 70 call spread for May. That's the 3rd Friday in May. All right, so one's a 30-day, one's a 60-day. So there are the 2 option trades that we've got that I wanted to show you. And we'll take a look at those and we'll kind of follow along with those and see how they end up. But they're both based off of this program here that we have called Triple Threat. All right. One's based off of the 1030, and that would be McDonald's. By the way, McDonald's is a money calendar buy as of this week too. So it's got something else going for it. But then look at Valero. Valero is based off of Triple Threat, and it's also based off of a longer term pattern that we're looking at, which is in the energy markets, right? Might also be the reason why it could be using a longer term option, because it's also kind of going with a longer term pattern right now too. So both some very interesting case studies that we can follow along with. All right. Jay, any questions?
Just one right now about with this pattern. What about earnings? How does that affect it?
Okay, so and we discussed that, is that I like to at least be out of half the trade if it's profitable by earnings. Okay. Now the great thing about these coming up into earnings is earnings does what to volatility? It makes it go up, and that only helps your position. Right? It won't help it over the top, make it a double or triple, but if the stock's going nowhere, it could keep the trade wherever it is at that time. Maybe you made a little, maybe you lost a little bit. As we go closer and closer to earnings, time decay tends to slow way down. and almost become in a coma until after that earnings announcement comes out, and then time goes right out the window and stock goes wherever it goes. Your real risk in a trade, especially in a trade where you're long calls or long puts only, is earnings risk. All right, you got that volatility risk. If you're in a spread, not so much, because you've hedged volatility to a major degree. All right, so
Yeah.
what we've kind of what